This is Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Asian stocks are set for gains as a possible de-escalation in the Middle East sends oil prices lower. President Trump putting off strikes on Iran's energy infrastructure after what he calls productive talks with Tehran. But Iran's parliament and media denying negotiations with the US, calling Trump's statement psychological warfare and insisting the conflict will continue. And Apollo Global Management curbing redemptions from one of its private credit funds, the latest alternative asset manager to grapple with a surge in withdrawal requests.
And take a look at how we're setting up for the market opens across Asia. Despite those conflicting signals coming from President Trump and Iran, we saw oil collapsing and that leading to that U.S. relief rally. Perhaps a lot to do with more than 50% of S&P 500 members being in the oversold territory. You can see U.S. futures pointing to the upside of 0.2%. We had that Fed repricing. Some more traders pricing in easing expectations, given that the inflation concerns have eased a little bit as well. We saw Treasury yields falling. A little bit of a different picture when we had the Friday session here in Japan because JGB yields were multi-decade highs. What's interesting is that despite we see yields rising here in Japan, we're seeing the Japanese yen weakening against the US dollar. You can see it sitting at that 158 level against the greenback. And that leading to analysts thinking from SMBC Nikko, for example, that this is the markets pressuring the Bank of Japan to tighten. Of course, today we do get inflation numbers out of Japan, so do watch out for that at a time when we have seen now labor unions across the country giving a more than 5% raise for third consecutive year. So we do have that demand also really coming from Japan and the labor market also staying firm. But when it comes to Korea, Kospi futures, look at that jump that we saw of more than 6% of the close. But what will be really key in the Korean market, Haidi, will be the Korean won because we are way past the 1500 level at the lowest since 2009 against the greenback.
So much of this, Shery, has been driven by all of the different ways that the war has impacted asset classes, right? The dollar, for example, with trading in gold and oil. Oil is still paramount. And we see really crude holding that large drop as we see the walkback of the energy infrastructure attack threats from President Trump. This is the picture when it comes to the open of trading for WTI. We're seeing a little bit of a sort of steadying, if you will. Brent crude is down by over just about 11%. We're seeing New York traded crude actually seeing a little bit of upside there. But take a look at gold, where we have also seen a little bit of respite as well, really releasing some of those big losses that we've seen in recent weeks, steadying as we kind of continue to weigh that pullback and the implications for both the dollar and the Fed. Well, President Trump's decision to delay threatened strikes against Iran's energy infrastructure coming after what he says were productive talks with a top person in Iran. The president is insisting both sides want a diplomatic solution to the conflict.
They want very much to make a deal. We'd like to make a deal, too. We're going to get together today by probably phone because it's very hard to find a country. It's very hard for them to get out, I guess. But we'll at some point very, very soon meet.
However, Iran's parliamentary speaker and state media denying any negotiations are happening, calling Trump's claim psychological warfare. Let's bring up Bloomberg Digital Politics editor Romy Varghese. And Romy, we are now sort of hearing all sorts of things from the president. What does he say are his goals now when it comes to this war?
Right now, Trump is saying that his chief goal is to prevent Iran from having a nuclear weapon. And he also wants the U.S. to retain control of the country's uranium stockpile. And of course, as we've heard, he claims that both sides want to make a deal. But of course, we have Iran denying that these talks are taking place. And they're insisting that the war will continue unless all sanctions are lifted. So these contradictory messages, really show that any deal would be a very difficult process and one that will take much longer than Trump would like.
Could this become President Trump's undoing? Because we have seen him really escape from many crises in the past, but that was a lot to do with his willingness to say lift tariffs. This doesn't seem something that he can do unilaterally, and we've heard from Iran that there have been no direct or indirect talks. How big are the stakes for the president right now?
The stakes are really high, and you could see that in the U.S. trading day when the early gains were kind of a little bit eased because there are these doubts that Trump can end a war as easily as he got into it. And our analysts are pointing to the fact that, the U.S. wants to be in negotiations, and Trump is looking for an exit ramp and maybe exaggerating progress as a way to reassure markets.
There's also a lot of pressure from allies that, did not want this war in the first place and have been critical in the way that it's played out.
Absolutely. Our reporting has shown that U.S. allies and countries in the region have been warning Trump that attacking Iranian energy infrastructure could result in permanent damage, and that would result in a failed state. And that would be difficult to achieve any goals. And they're also warning that those attacks could wreak havoc on markets. And our reporting shows it was not a coincidence, the timing of Trump's Truth Social post. It came right before the U.S. trading day began, and we saw an immediate drop in Brent crude.
Even if the president really wanted to end this war and we have Iran even coming to the negotiating table, how likely is it that Israel also will go along with what President Trump wants? Because they don't seem to be signaling any de-escalation at this point.
Yes, Israel has not signaled any de-escalation, and I think it's really going to depend on what happens over the next few days. We are hearing that Witkoff and Jared Kushner are going to be having these discussions, but this is a very difficult process. I mean, even before Trump took these actions, both sides were very far apart. And with Iran insisting that they are going to continue unless sanctions are lifted, and Trump needing to show that he has achieved something, this is going to take a while. And of course, we are seeing that there are still plans from the Pentagon to deploy soldiers. So even as Trump is talking about their negotiations, both sides want to make a deal, there are military preparations going on.
Our Bloomberg Digital Politics editor, Rami Varghese there. Well, possible de-escalation in the conflict has rippled through the markets. Oil falling, stocks rising, Treasury is also seeing that big move, at least in the first few minutes of that reaction. President Trump backing off his threats to attack Iran's power plants. Garfield Reynolds leads our Markets Live Asia coverage and joins us now. It was a wild ride, and we know the timing of this announcement as well. You do have, obviously, the TACO trade, which a lot of people were expecting, but how much is that going to fade given how asymmetric these negotiations seem to be?
Well, you saw, in fact, that the stocks rally faded fairly rapidly. Equity still ended higher in the US and substantially higher, but they did pare their gains, just like oil came down by a lot. And it still closed down a fair way, but not anywhere near as far down as the initial move, especially once Iran came out to contradict some of what President Trump had said. So Brent closing just below $100 a barrel, that's still an extraordinarily high number for crude. That underscores both, I think, investors' concerns that, there's a long way to go before you get real progress on peace, and also the simple fact on the ground that even if there is peace, you've got some severe damage to Middle East oil infrastructure, and that's going to have impacts for some time to come. For Asian stocks today, though, the news is everybody's going to be piling back in.
It's interesting, though. I think Shery made the very good point that Trump's ability to drive markets up to this point has been his ability to act unilaterally, right? Does this show the limitations of his jawboning?
Oh, absolutely. It shows, it's a little bit of a boy who cried wolf effect. I think it took a while for it to come through, but it is finally coming through, and investors are understanding, that when Trump breaks things, that damage sustains, and B, that he has got himself into deeper and deeper waters when it, geopolitically, where there's no clear off-ramp still for how you bring this war to an end, given both that Iran has said, we're not stopping the conflict and Israel continues to attack, but also that the two sides have laid out aims for what could bring a resolution that are very much at odds with each other. Now, that doesn't mean peace can't come, but it's going to take a while. Remember how long it took President Obama to win the agreement with Iran. That took months and months. So it's going to take plenty of time. And in the meantime, you've got that damage. I think the IEA head yesterday was saying something like 40 major energy assets that have been damaged in the Middle East. Repairing those, bringing those back online is going to take months, if not years in many instances. And that's something that the global economy is going to have to cope with.
To your point, the IEA is saying that this is the largest oil supply disruption in history. It equals and puts together two major oil crises in the 70s and the 2022 natural gas crisis when Russia invaded Ukraine. This will be painful for Asia. What will the markets do in this week, especially given all of the fluctuations of Iran-US talks or no talks?
Well, I think Asian stocks will bounce back today, and will probably hold those gains as long as the fighting, remains at the sort of relatively quieter levels that we're seeing at the moment. Going forward, there is going to be some concerns, I would imagine, especially heading into the weekend, assuming that we've got this same sort of setup where no real fighting, but still the potential for escalation. And especially, you have to ponder, there's going to be plenty of investors who might have been looking for some clarity, holding on to their positions, especially if they're still sitting on gains, and Asian stocks had gained a lot over the last year, and thinking, well, maybe now is a better exit point. They didn't want to exit amid the panic, because then you're selling into the rout, you're exacerbating the rout, you are locking in either losses or smaller profits than you otherwise would. But this bounce that we're going to get this week could be seen by some as offering a superior exit point to what they might have had amid the sell down.
Garfield Reynolds, who leads our Markets Live Asia coverage. Take a look at some of the early movers that we're seeing so far in Australia. Energy names as well as miners in focus. We are seeing, of course, the ones that have gained throughout the course of this conflict, the likes of Woodside Energy, Santos, the crude energy and LNG related names are seeing a bit of a pullback in the morning session. On the other hand, though, we are seeing Australian miners gaining as that delay of the strikes on Iran has been boosting metals. We saw copper jumping overnight after Trump said that the US would postpone those planned strikes and elongating that deadline for negotiations to 5 days, even as we've seen that denial from the Iranian side about any negotiations taking place. But of course, copper being the bellwether for the global economy had earlier slumped to the lowest in more than 3 months. We're seeing some of these mining names amongst the biggest gainers so far. We are also taking a look at the RBNZ as well, hearing now from the RBNZ talking about just this state of geopolitical and macroeconomic flux globally, saying that they don't see any financial stability issues arising right now. They don't see the need for alternative policy measures as well. Also talking about really leaving the ability to be flexible, not ruling out rate hikes or rate cuts at this point. We continue to really watch this as Governor Breman has signalled that they won't be rushing to raise rates in response to the inflation risk coming from the Middle East conflict. She's been talking about a short-lived disruption, a temporary increase in petrol prices that can be looked through from a monetary policy perspective if it's unlikely to have that medium or long-term inflation outcome result there. So this, in terms of the market reaction, raising some of these or easing some of these bets on earlier tightening, that chance of a May hike dropping to 36%. It was over 90% on Monday, Shery.
Yeah, and Haidi, still in the early Asia session, though, we're seeing oil prices on WTI gaining a little bit at the moment. We'll have more on the outlook for energy markets next. Goldman Sachs raising its oil price forecast for the year. Their co-head of global commodities research, Daan Struyven, joins us next. And later, we'll also assess Australia's energy security with Macquarie University. And Hong Kong's Financial Services Secretary Christopher Hui will tell us how the Iran war is presenting both risks and opportunities for the city. Much more ahead. This is Bloomberg.
Markets do what markets do. Prices went up to send signals to everyone that can produce more, please produce more. The prices have not risen high enough yet to drive meaningful demand destruction.
U.S. Energy Secretary Chris Wright speaking at CERAWeek in Houston despite his more optimistic remarks on oil. Goldman Sachs now raising its outlook on oil prices, expecting Brent crude to average $85 a barrel this year, up from its earlier forecast of $77. They note that the disruption in the Strait of Hormuz is the largest ever supply shock in the global crude market. You can see right there that WTI is now gaining slightly in the early Asian session after plunging more than 10% in the previous session. Joining us now is Daan Struyven, co-head of Global Commodities Research at Goldman Sachs. Dan, great to have you with us. Are we now in a structurally higher oil price regime?
Yeah, so we do have a somewhat higher oil price forecast even for the end of this year than before we entered the conflict. So in the absence of the Iran war, we think that a reasonable price for Brent would have been sort of in the 60s, and now we forecast Brent by year end of 80. We do think that the largest oil supply shock ever is going to lead to two structural changes. One, faster strategic stockpiling by governments as they're going to deplete SPRs this year and realize that in this uncertain supply environment, you probably want to have a higher target level for your SPRs. And second, I think the recognition of the risks associated with the high concentration of production and spare capacity is probably going to lead to the pricing in of a security premium in longer dated prices. And so we now expect a somewhat higher oil price of Brent 80 by year end, both because of the damage from the Hormuz shock to global commercial oil inventories and because of those two structural factors I just discussed.
At the same time, Goldman Sachs notes that perhaps the supply shock is not fully spread in the West, with the U.S., Europe, for example. Asia, of course, is feeling it already. Does this mean that things get worse from here?
Yeah, absolutely. That's one of the key reasons why you have this very large gap between extremely elevated crude prices, for instance, in the Middle East for Dubai or Oman marketers, that are very relevant for Asian refineries on the one hand. And then on the other hand, the Western crude benchmarks, including Brent in the North Sea or especially WTI in the United States, which are less elevated. In the end, the oil is a physical market. And while we're seeing extremely large draws in inventories in the Middle East, in Asia, large draws in oil and water, actually in the US, crude oil inventories are still edging up. Because before the shock started, global supply on our estimates was exceeding global demand. Now, if this shock lasts longer, this extreme tightness that's now concentrated in the Middle East and Asia would spread to the rest of the world, because these very big prices in Asia and the Middle East create very strong incentives to ship barrels, for instance, from the US to Asia, and that should eventually narrow the gap.
What sort of upside risks do you see to that forecast? And I guess, does the rhetoric or the jawboning that we hear from President Trump change that assessment at all?
So it's an important reminder that the risks to oil prices are two-sided, especially in the short term. I think it's important to distinguish between how we forecast prices over the medium term after the shock. There it's based on fundamentals, counting the barrels, while in the short term, we think that a lot of the price increases we have seen reflect a risk premium as the market tries to hedge against the risk scenario, not necessarily the market's base case, but against the risk scenario of a long disruption. And so today, while I think the base case for many investors did not change dramatically, I think in the minds of many investors, the probability of a very lengthy disruption or the probability of substantial persistent damage to oil production potential, that probability has come down somewhat. And if the price on the screen ultimately reflects sort of a weighted average across outcomes, I think the reduction in the probability of the right tail of very high prices helps to explain, the almost 12% sell-off we saw in Brent on Monday.
The gap between Brent and WTI has been such an interesting one, right? Particularly if we consider the sort of outsized role that pump prices have in the US economy. When you look at it from that angle, do you expect this to motivate more US shale to come online?
So at the margin, we would expect somewhat stronger shale supply, but I think it's modest. We could expect perhaps 300 or 400 kbd of extra shale production over the next year as a result of the price increase we have seen, perhaps a little bit higher because of the hedging at higher prices that some producers have locked in. Now, taking a step back, that is quite small compared to the roughly 18 million barrels per day hit to exports of oil from the Persian Gulf that we're experiencing at the moment. Even policy, while it can be quite powerful, including SPR releases, releasing sanctioned crude, even policy cannot fully offset this extremely large shock. So if this shock lasts, and to be clear, our base case is that flows start to recover in mid-April. But if the shock lasts longer, and that's definitely plausible, you can't absorb this very large shock with policy levers. Ultimately, you cannot draw inventories forever. And so if the shock were to last for a long time, or if you were to see persistent damage to oil production potential, eventually demand destruction via higher prices would be required to help to rebalance supply and demand.
And that demand destruction, for example, being felt already in other commodities, we have seen the pullback of base metals, for example.
Yes, so we're seeing pockets of evidence of demand destruction. You're seeing it, for instance, in the LNG market, where LNG deliveries in countries that tend to be somewhat more price sensitive, Pakistan, Bangladesh would be examples, have come down somewhat. In the oil market, we have seen now headlines from 3 airlines planning to cut their flights by about 5% of normal levels. Jet prices now exceed $200 per barrel in several Asian and European geographies. And so at these extremely high prices, since jet fuel tends to be about 30% of airlines' cost in normal times, these extremely high jet fuel prices are likely going to lead to demand destruction. Obviously, it will all depend on the duration of this disruption, which is really why we have laid out scenarios for investors to think about the effects both in the short term and the medium term, depending on the length of the disruption and depending on whether there is persistent disruption to oil production potential.
Dan, we really appreciate your time with us. Daan Struyven, who's a co-head of Global Commodities Research at Goldman Sachs. There's more on energy coming up in the next hour. We'll be talking about what would happen if Australia's 36-day petrol supply runs out. An expert from Macquarie University will be along with us. More ahead on the Asia trade. This is Bloomberg.
We've been watching emerging market assets. We saw EM currencies jumping in the previous session. Of course, the moves have been pretty extreme in this sector of the market as well. We have seen the US dollar, for example, falling, and that's led to a little bit more of a boost. On the other side of that trade, of course, there's more optimism about a potential easing of geopolitical tensions around Iran, with the comments from President Trump about delaying those strikes on Iran's energy facilities. Do watch out for gold, because that relationship with the dollar has broken down, has actually fallen despite the geopolitical tensions. We have more ahead. This is Bloomberg. We have breaking news out of Japan. We are getting the February inflation numbers. Core CPI excluding fresh food coming in at acceleration of 1.6%. This is below economists' estimates and also is a deceleration from the previous month. But remember, we do have some energy subsidies to contend with. And the truth is that underlying price pressures remain quite firm. We're talking about higher labor costs, a weaker yen as well. The headline inflation is year-on-year growth of 1.3%. Take away food, but also take away energy prices, of course, the oil spike, and you get the February inflation numbers at growth of 2.5%. Deceleration from the previous month, also coming in below economists' expectations. But let's discuss the numbers and bring in Tokyo economy and government reporter Erika Yokoyama. Erika, so react to these numbers because we were expecting the energy subsidies to be felt in the price pressures that Japan is feeling, but at the same time, we keep getting more positive momentum when it comes to the labor market, for example.
Yeah, sure. Just talking about the consumer prices index this morning, the headline inflation slowed to the weakest pace in nearly 4 years. But that is, as you said, largely due to the government's utility subsidy, and underlying inflation still seems to be pretty solid as well. And, like price pressures are likely to remain, especially with the recent oil price surges. Gasoline prices hit 190.8 per liter yen per liter. That's the record so far. And although like Prime Minister already announced like she's going to implement the subsidy to cap them at 170, I think household will continue to face the cost of living, higher cost of living inflation pressure. So far, so the softer inflation data is not really easing pressures to price pressure to household, and especially that's a problem as many have been facing elevated living costs for over 4 years.
We had the wage tally from the largest labour union group yesterday. Did we get sort of evidence that the wages part of the virtuous cycle is making progress?
Mm-hmm. Yeah, right. So the Lengo's workers secured 5.26 pay gains in total pay yesterday. That was slightly weaker than last year, but still it exceeded 5% for 3 consecutive years. And base pay growth was much significant. It's actually exceeded the last year level as well. So I think it's suggesting a solid underlying momentum, some vertical economic cycles there. This is encouraging, especially given the headwinds that Japanese companies have been facing over the year, including higher U.S. tariff and rising input cost. But the key question here is whether this momentum continues and spread to smaller companies, which will settle in April or later. Some labor union leaders already said and voiced the concerns about the Middle East impact on their wage negotiation ahead. And Lengo Chair Yoshino said at the press conferences yesterday that test is still ahead, so we have to keep eye on that.
Yeah, the Middle East concern is pretty pervasive, right? They were really addressed by the BOJ as well during the last meeting. We are expecting those minutes to come out in a few minutes. What are they looking at ahead of that policy decision in April?
Sure. Yeah. So the wage momentum is one thing that they are clearly looking at, because 70% of Japanese workers are employed by these smaller companies. So they are actually holding key whether consumption can be sustained by these higher wage. In that, and markets are now pricing in a roughly 60% chance of a rate hike in April, but it's very volatile. We can't really expect what's going to happen, especially the Middle East situation is also important in that sense because, Japan imports 90% of oil from the Middle East. If higher energy costs start squeezing corporate margins, the outlooks crowd immediately. And also we have to keep eyes on the yen trajectory as well. It's now nearly 160 per dollar. If it started to squeeze the corporate margin, that's another risk.
Bloomberg's Tokyo economy and government reporter Erika Yokoyama there with us. All the top global headlines that we're following, and New York's LaGuardia Airport has reopened with reduced capacity after an Air Canada Express plane collided with a fire truck on a runway late on Sunday night, killing both pilots. Recordings reveal an air traffic controller ordering the truck to stop just before the impact with the plane, which was travelling at more than 200 kilometres an hour. 76 people were aboard the aircraft, more than 40 needing hospital treatment.
As our airports go, LaGuardia is a very well-staffed airport. We're a couple controllers short in total, but it is a well-staffed airport. Again, 33 certified controllers that operate out of the tower here at LaGuardia.
Italian Prime Minister Giorgia Meloni has conceded defeat in a national referendum to overhaul the judicial system. Almost 54% voted no to reforms in legal training and overseeing the careers of judges and prosecutors. The result is Meloni's biggest political setback since taking power in 2022 and comes ahead of a general election expected next year. Indian Prime Minister Narendra Modi says the country has sufficient energy supplies to meet domestic demand. He spoke as a gas shortage hits industries from restaurants to fertilizer makers and oil refiners. Modi says India holds over 5 million metric tons of strategic oil reserves and is helping ensure safe transit for Indian vessels that are stranded in the Middle East. Well, that oil price continues to be paramount as we see something of confusion returning to these markets. We have oil, at least when it comes to compared to the overnight session, we are now seeing some modest gains when it comes to trading in WTI. S&P futures, though, looking like we'll see a little bit more positivity, and we are watching any sort of reaction in the dollar. But the sort of trading across asset classes as well as that fade in risk assets really reflecting the confusion that we continue to get between what President Trump is saying and what we're hearing from Iran. Let's bring in our Randa Slim, who's a Middle East program lead at the Stimson Centre. So President Trump clearly looking for an off-ramp. He's extended this deadline for negotiations to 5 days. The Iranians say no such negotiations are taking place. And in fact, you know, the tone and the aggression is pretty intense coming from that side. Is this an asymmetric desire to find an end to the war at this point?
No, I think we have entered the bazaar phase of this war, and each side is going to try to get as much as possible ahead of the actual negotiation and trying to improve their position. And that's what the Iranians are doing. If we look at the contacts that have been established, for example, between the Iranian officials and Pakistani officials, who are rumored to be one of the trio countries that are helping with the mediation right now between the two countries, it proves that the Iranians are speaking with a potential mediator. Now, whether they have agreed on the terms of a meeting, I think Mr. Trump maybe has gone overboard, partly to help shape the market ahead of this morning opening. But definitely the two sides are interested, and each one is going, especially the Iranian, is going to try to improve the pre-negotiation conditions, let's put it this way, in their favor.
I think it's easier to see a scenario where the US and Iran can come to the table for some sort of ceasefire compromise. What about Israel, though? Because they have a fairly different set of ambitions in this conflict.
I totally agree with you. I mean, Israel remains interested in achieving its objective, which is Iranian regime collapse. The Americans are not interested in this objective. They want somebody who they can deal with, you know, as Mr. Trump put it, another Ayatollah or another insider from the regime that they can deal with, similar to the Venezuelan model. But at the same time, Israel cannot wage this war the way it is being waged without the American approval and the American assistance, and especially without Mr. Trump approval. And so I think they are going to be in a bind. At some point, they have to accede to Mr. Trump's demands if he gets to the point where he wants a ceasefire.
Randa, where is the Iranian uprising, the popular uprising that we keep hearing might come, especially at a time when Iranian security forces have been battered by these U.S.-Israeli strikes?
But yes, but when bombs are falling, you know, from the skies on your towns, on your cities, it's very hard to go into the streets and do an uprising. I mean, I lived through a civil war in Lebanon, and I know what people feel when you are in a state of war, and it's going to be very hard later. Now, if the regime survives, it's going to survive weakened. It's going to survive hollowed out. Then you have conditions, political conditions on the ground that could lead to the regime collapse and change. But in a war scenario, it's very hard to have a citizen uprising.
How strong is the Iranian regime right now? And I'm not just talking within the country, but also when it comes to its proxy ecosystem.
The proxy has been weakened, but at the same time, we thought that Hezbollah has been weakened a lot. Now, we knew that it was weakened, but not defeated. But we did not think, at least I did not think, having studied Hezbollah for a long time, that they will be as able as they have shown until now to be able to mount an attack in response to the Israeli attacks on Lebanon. The Hashd in Iraq, the PMF, seems, they are strong, but not as strong as Hezbollah. And the Houthis have not yet joined the fight. They are being held in reserve, in my opinion, by the Iranians.
And how are you factoring in U.S. domestic politics in how this conflict also really evolves from this point? Because we have seen, as Haidi mentioned, President Trump really wanting an off-ramp from here. But where do we go with Washington politics really combining with what the Israelis want and how this conflict might evolve?
Look, there are two factors that are going to push the American administration to seek a ceasefire. One is munitions. They are running low on munitions, and their ally is running low on munition. We know that the countries in the Gulf are running low on interceptors. And then the second is basically money, is the stock market and the impact of not only the stock market, but oil, fuel. And now we are starting to hear from American farmers who are paying too high a price for diesel. They are running short on fertilizers. So you are going to start seeing now the impact of this war manifesting itself domestically in different segments of the American society.
Yeah, on those costs, the Pentagon now requesting an extra $200 billion for the war, right? Randa Slim, good to have you with us, Middle East program lead at the Stimson Center. And of course, subscribers at Bloomberg can get more on the Iran war in our new video hub. There's also live streaming, news and interviews, all our Bloomberg TV shows, documentaries, report analysis, and more, much, much more. Check out bloomberg.com/videos. This is Bloomberg. Take a look at how some of the stocks in Japan and Korea are setting up as we head towards the market opens. Of course, we're seeing broader optimism in the markets after the collapse of oil prices and perhaps some indications that President Trump wants to make a deal with Iran. You can see right there pre-market trading for Samsung and SK Hynix pointing to upside of more than 5%, and this coming at a time when we have seen the cost be under pressure with the Korean won also trading at the lowest levels since 2009. Also, we'll be following markets across Japan. Bloomberg has learned that Sony is nearing a binding agreement to sell a majority stake in its home entertainment business to Chinese rival TCL in a deal that may be valued at about $1 billion. Sources say the two companies have made progress on their negotiations and are seeking to announce a transaction as soon as this month. Also, do watch out for Toyota at the open in Japan. ADRs closed up almost 3% after it outlined plans to invest $1 billion to increase vehicle output at its plants in 2 U.S. states. That's part of a broader commitment to spend up to $10 billion in the U.S. over the next 5 years. Let's get more on this from Bloomberg's Detroit Bureau Chief, David Welch. David, what will those investments look like?
They're going to add some production in plants in Ohio and Kentucky and Indiana that'll add production of the RAV4. They're going to add an electric vehicle there. It's not a huge jump in production for them because they're not adding any employees, but they will have the ability to sell more vehicles in the U.S. that are made here. Maybe they can cut down on some of their imports. They've been under a lot of pressure from President Trump. All Japanese companies have to add more production in the United States. Toyota particularly because they get about half of their U.S. sales from vehicles that are made in Japan. So you're not looking at a huge investment here. $1 billion sounds like a lot, but a lot of that is what they spend on an ongoing basis to upgrade their plants. But I think the company is really trying to avoid tariffs as much as they can, play nice on the trade front, and just build more vehicles where they sell them.
Yeah, I was going to say how much of this is really tariff related, right?
Some of it certainly is, but I always get a little suspicious of these things in terms of how big they are when they aren't adding a lot of employees. It's a real amount of money, and it's a big commitment over the next 5 years for Toyota. They'll be spending a lot, but it is a huge market for them as well, and they do continue to spend money when they upgrade vehicles or completely redesign them. And they always make an investment in the plants when they do that. So there's some real new production coming in, but with no new employees, it's not a really big shift from something they're doing in Japan. I think what you're really seeing is probably adding production here because they think they're going to be able to gain market share, particularly with a vehicle like the RAV4, which is very popular in that small SUV segment. It's a market leader, and I think the company probably believes they can find more customers if they have more U.S. production.
Yeah, most taxis in New York are those RAV4 from Toyota. Detroit Bureau Chief David Welch, really good to have you with us. And we continue to follow the latest developments in private markets. Apollo now curbing redemptions from one of their largest non-traded private credit funds for retail investors at 5%. After requests hit 11%, it's the latest alternative asset manager to find itself grappling with a surge in withdrawal requests. Let's bring in Bloomberg Asia credit editor Finbar Flynn. The reckoning of private markets, perhaps. I mean, we've seen these cappings by BlackRock, Morgan Stanley's funds as well.
Yes, this is just the latest in one of these, I suppose, gates on keeping money into the fund. I think the release today, or should I say yesterday in the United States, was quite interesting. We saw that the fund has about $5 billion in liquidity, so they say they can cover 7 times estimated redemptions for each quarter. But I thought it was interesting that they said that if you wanted your money back, that those people who wanted their money back, they'll likely only get 45% of their money back in this redemption. So it's not like, give me my money back and it comes all back your way. They'll pro-ratio out that.
How concerning is that?
So this is for retail investors, and I think this is one of the risks of these funds. Did those people who went into the funds have full awareness of this? One certainly hopes so. And I guess I'm looking at, I do not think this is the end of the story. I think we're probably in this for the rest of 2026. I think a lot of these funds, even when they're mentioning the liquidity, they're quite aware that this is something that's not going away, and other investors aren't piling in to pick up these loans.
That's interesting. You don't think this is settling down, so going forward, what are the risks that we should be watching out for?
So I thought there was a really good report from the University of California, Berkeley recently, and it played out the actual scenario that you have the private equity firms own the companies, the private credit units are lending to the firms, they own the insurance companies that are putting the money into the actual PE firms, and they even sometimes own the reinsurers of that fund. So it's very interconnected. We're keeping close tabs on it to see how these, I mean, the big risk is these links are very interlinked, and I guess in the Middle East as well, how the economies, these are weaker companies, these are high yield companies, so we have to see how the economy works out and how that feeds into all these, these earnings.
Yeah, and these PE firms that we're talking about have been circling the Japanese market as well for opportunities, so we'll be watching those risks as well. Finbar Flynn here, Bloomberg Asia credit editor with the latest on those private credit funds. We have more ahead on the Asia trade. This is Bloomberg.
We are continuing to watch oil prices as we have something of a one-sided rhetoric at the moment, with President Trump delaying these strikes on energy infrastructure, setting that 5-day deadline now for negotiations on a ceasefire with Iran. The Iranian side, of course, has been left forthcoming when it comes to whether these talks are taking place. We are seeing creeping gains now when it comes to WTI, some downside for iron ore and gold, staging a little bit of a recovery. Well, the top US gas producer, EQT, says expanding pipeline infrastructure is essential to addressing rising energy prices. Speaking to Bloomberg at CERAWeek in Houston, CEO Toby Rice discussed where things stand with the Trump administration.
It's all about affordability. It's all about reliability. It's about transforming our energy independence into energy dominance. And what energy dominance means, that means America is prepared to win the AI race. That means America is prepared to provide energy security to our allies, where their energy security around the world has been crippled from what Russia has done to what's happening right now in Iran. And so this is a really critical time. It's never been more important time for us to produce energy in this country than right now. It's also never been more difficult. And a lot of the conversations that we're having in D.C. is about fixing that last part. And to make it easier for us to get energy built in this country, we need to get serious about permit reform. And that needs to be a focus in D.C. to enable the greatest industry in the world, American energy industry, to do what we do. And that's keep energy cost effective, reliable, and clean.
You know, you touched on affordability. It's something we're hearing a lot about right now. How about electricity bills? What are your conversations like with the administration about that?
That has been a big catalyst as American energy bills are up over 35% since 2020. What's important for Americans to know is your energy bills were going up before Iran. They were going up before AI and people started talking about these data centers. This is something that has really started in 2020 and bills are up. And that's across the board. But specifically on electricity is really a catalyst that everybody's looking at right now. And when we diagnose this issue to solve this issue of lowering electricity prices, it's very simple. The reason why we find ourselves in this situation is because we've blocked, canceled, and imposed many pipelines that the market forces have said are critical and needed. And those pipelines have been blocked and shut down. Demand has not stopped. Demand has continued to grow. And when you have lower supply, demand high, that's when prices go. And New England is a poster child of where this has gone badly. But the solution is very simple. Build more pipeline infrastructure, bring our low-cost energy resource, natural gas, to the doorstep of New England, and electricity prices will drop significantly.
While you think there should be more pipelines, in the meantime, while there isn't, what's the solution? The solution is
they're going to do everything they can to keep the lights on. And let's look at what happened in Winter Storm Fern. New England was burning 40% of their electricity was coming from oil, okay, burning trash. This is the type of desperation moves where they saw their energy bills during this winter period. Natural gas prices spiked to almost $150 an MCF. And what's remarkable about this is we were selling gas next door for a price of $6. OK, so people need to understand that these energy issues are completely self-inflicted. They're completely corrected. And we have the solution here domestically.
EQT CEO Toby Rice speaking with Bloomberg's Julie Fine from CERAWeek. We do have the market opens in Seoul and Tokyo next, with futures pointing to some upside. This is Bloomberg. This is Asia Trade. We're counting down to Asia's major market opens with some optimism for the markets, given, Haidi, that we're seeing some signals from President Trump that he's ready perhaps for a deal with Iran, although conflicting signals for Iran that says there was really no conversations, direct or indirect. In your neck of the woods, we are watching that EU-Australia trade deal.
Some optimism here too, Shery, all about feta, Prosecco, Australian beef. The EU and Australia have agreed to a free trade deal, according to a joint statement that has just been announced. A new security defence partnership as well, but the conclusion of free trade pact talks. Shery, this is a deal that's 8 years in the making.
Yeah, and then they were halted back in 2023, but it seems the EU really looking forward to more of these trade deals with different countries. We saw them actually strike one with India just in January. But take a look at how we're setting up for the market opens across Asia, because Japan is now coming online to the upside of more than 3% for the topics. Of course, we are watching the Japanese yen at the moment, not doing much, but after some weakness against the U.S. dollar lately, of course, not surprising, given that we are seeing energy prices become an issue globally, and the fact that Japan gets most of its energy from the Middle East. That's a key concern, which is really not what we were expecting in FX moves here in Japan, given the JGB yields in Japan have also risen to multi-decade highs. The likes of SMBC Nikko now saying that this is a signal from the market telling the BOJ to tighten. Of course, we have seen inflation numbers earlier today, a deceleration both on the core inflation numbers and the headline inflation numbers, but mostly because of those energy subsidies. Take a look at how South Korea is also opening, because we have seen significant weakness in that market as well, especially with the Korean won now past the 1,500 level against the U.S. dollar. We're holding very close to levels that we haven't seen since 2009. Upside on the Kospi and the Kosdaq, as we are watching some of those market leaders like Samsung and SK Hynix on the tech side of things as well, Haidi.
Yeah, take a look at what else we're watching when it comes to treasuries, right, which has been a space that's been badly affected by the Middle East conflict. We're seeing yields falling from highs now as we've seen the slide in oil playing out as well. Also watching what's going on with the dollar, which of course has been so closely tracked when it comes to the gold price. We're seeing some respite for precious metals there as well. Brent crude, as you can see, we had a big move overnight, but when it comes to WTI at the moment as well, we're starting to see some smaller gains come through. Shery.
Let's actually discuss everything that's happening in the markets. Joining us now is Suresh Tantia, head of CIO for Asia Equity Strategy at UBS Global Wealth Management. Great to have you with us. How do you take the latest signals coming from President Trump and Iran? And is this positive sentiment that we're seeing in the markets justified at this point?
I think it's quite likely that this week we see a relief rally, given the markets were oversold. But this might not be the final solution. The situation is still very fluid. It's quite possible that a week later we get a further escalation because they are asked from both sides, and it might be very difficult to reach to a final conclusion within a very short period of time. So I think markets could still remain very volatile in the short term. Our base case is that 4 to 6 weeks down the line, we should see a resolution of the conflict because it's not in favor of both. But having said that, path to that resolution could be very messy.
In the meantime, of course, we have seen the volatility in gold prices as people are trying to hedge. Right now, we saw that sort of breakdown when it comes to the safe haven correlation with the U.S. dollar. What do you make of some of these assets and how they're trading as safe havens, and where would you go to hedge?
It's very common to see this kind of pressure on gold during liquidation crisis because investors were raising cash in this crisis, and that's why they were selling any asset which had made profit this year. So we saw profit booking in gold, in Korean equities, in Japanese equities. In the short term, we do think gold is still a very good hedge, especially after the 10% pullback in the last few weeks. At this kind of level, it makes sense to buy gold because eventually we do think Fed will deliver on rate cuts, dollar will be weaker. So gold will bounce back. The other areas investors can look at is a short-dated investment-grade bonds. Although there is a bit of uncertainty on how the Fed is going to proceed on the rate cuts, but at least short-dated bonds are not going to be affected, and the yields are pretty juicy at current levels.
Would you still recommend keeping some powder dry when it comes to keeping cash?
It might not be a bad idea to keep some cash on the sideline. At least investors should hedge a little bit of risk in the equity side, reduce cyclical exposure. That's what we are doing in our client portfolios because you can never be sure, and the tail risk is very high. Once this thing gets resolution, then I think we should see a very strong bounce back in the equity market. But meanwhile, reduce cyclical exposure, diversify, and keep some cash on the sideline.
It's interesting, Suresh, I see Germany, India, Eurozone facing the highest short-term risks. If you take a step out, where do you see, I guess, less risk or more opportunity? Would China be one of the markets that you could consider?
You're absolutely right. And this morning, actually, we downgraded Eurozone equities and Indian equities from attractive to neutral because they are more cyclical and going to be more affected by the high oil prices. Within Asia, I think Chinese equities are going to be more resilient because China will keep getting the oil through the Strait of Hormuz. Inflation is low, and the market has massively underperformed Asian markets over the last 6 months. So we don't see further downside in China equity market from current levels unless the tail risk scenario plays out. The other areas to look at in Asia would be investment grade bonds, and definitely gold is still a very good hedge at current levels.
When it comes to broader risk sentiment, how much does it help on the margins? News that we have European Union, Australia trade deal. I know that we're very much distracted with the ongoing Iran war, but if we see more positive sentiment by allies, by other countries, not revolving everything around the U.S., could we see some help for markets?
It's quite possible that we do see a bit of relief rally, that market attention shift from the Iran crisis to the free trade deal, which indicate towards continuation of the global economic growth. But at the front and center, we are still going to be focused more on the Iran crisis because the tail risk is very high. If we don't see a resolution, it's quite likely that we see substantial pullback in the markets. So at the margin, it does help. But I think we do need to see a resolution of the crisis in the next 4 to 6 weeks.
In the meantime, central banks around the world just struggling to understand what the implications of surging oil will be. Here in Japan, we got inflation numbers that decelerated, but it seems that when it comes to JGB yields, for example, they continue to rise to multi-decade highs and the yen continues to weaken. What are the implications for investors when they look at this market? And we have already seen an incredible rally in the last few years.
Yeah, I think it's quite possible that the JGB yield continue to go higher, especially as US yields have been going higher in the short term. But on the equity side, we do think that this pullback in the Japanese equity market has been oversold, and this is actually a buying opportunity. In the short term, yes, market could remain volatile. But if you look at the medium-term outlook for Japanese equity market, the earnings this year should be up close to high single digit. And there are reforms coming from the government on the macro front with fiscal spending and more corporate governance reforms. And that should support higher equity prices. Short-term more volatile, but eventually I think we should see a recovery in the Japanese equity market.
Suresh, really great to have you with us. We appreciate your time. Suresh Tantia, who's a head CIO, Asia Equity Strategy at UBS Global Wealth Management. More ahead on the Asia trade. This is Bloomberg. Take a look at what we're watching when it comes to energy and oil-related shares trading across the region. Some really firm downside there from what has really been companies that have been the biggest beneficiaries of the previous oil price spike. Santos, Woodside Energy here in Australia, each trading down by about close to 2% when it comes to Woodside, but we have had sustained gains over the past few weeks. Broader markets, though, are trading higher. We're seeing Impex, they're trading in Japan, also a little bit softer by about 0.25% there. This after President Trump said the US would postpone strikes against Iran's energy infrastructure, that 5-day deadline now being set for negotiations. But really, when it comes to oil prices, we heard from Vitol Group, the CEO there, saying that markets are pricing in a reopening of Hormuz sooner rather than later. So that singular focus remains as investors continue to ponder what we heard from President Trump, the decision to delay threatened strikes against Iran's energy assets, coming after what he says were productive talks with a top person in Iran. The president insisting both sides want a diplomatic solution to the conflict.
They want very much to make a deal. We'd like to make a deal too. We're going to get together today by probably phone because it's very hard to find a country. It's very hard for them to get out, I guess. But we'll at some point very, very soon meet.
However, Iran's parliamentary speaker and state media deny any negotiations are happening, calling Trump's claim psychological warfare. Let's bring our Washington Deputy Bureau Chief Laura Davison. And Laura, do we have any evidence that these negotiations are two-sided? Is this sort of gamesmanship on one or both sides?
There's a lot of speculation here that Trump is, if not, just making up these talks entirely, is at least overstating the amount of talks that are happening. Iran has continued to deny that there's any sort of formal negotiations happening, though there is some reporting this morning that Iran is indicating that they are reviewing some information that has been passed through mediators. Oman and Egypt as well have been involved in some of this back channeling. But what Trump has come out and said that there are major points of agreement, that there are these are substantive talks that are kind of could be resolved within the matter of 5 days. He put this deadline here. U.S. officials, however, are privately conceding that these talks are really just in early stages and aren't necessarily leading to an imminent breakthrough. However, it's clear that Trump was very concerned about what he saw in Asian and European markets yesterday. He came out in the U.S. morning before markets opened, sort of with this message that he was going to be backing off of that 48-hour ultimatum, saying that he would strike energy sites in Iran, by Monday evening if they hadn't agreed to open the Strait of Hormuz, and really bought himself more time here. So it's the U.S. is looking for an off-ramp to this war, though it's unclear. There's sort of mixed signals coming from the president, and even that not clear that what he's saying is as firm as he's signaling it might be.
In the meantime, Laura, U.S. allies in the Gulf, for example, are getting tougher when it comes to fighting back against Iran, or at least supporting the U.S. in those efforts. We have heard now that before the U.S. decided to attack Iran, they had actually warned, together with other allies around the world, about the risks of escalating the conflict.
Yes, another sort of factor in Trump's decision to pick an off-ramp yesterday is that allies in the region were, indicating that, that kind of destroying Iran's energy infrastructure could lead to a failed state, and that they were looking at kind of what happens after this war, and that you could have, an even worse situation in Iran than you do currently. Allies, have really been ramping up pressure since the start of this, warning that, they don't have infinite supplies of these missile interceptors, that there's, if infrastructure and all these countries continue to be destroyed, there could be sort of pandemic level, shocks to the economy with shutdowns, with oil not being available. We saw this, kind of happen in the stock market yesterday in both Asia and Europe, but then also, yesterday morning in the U.S., seeing the Treasury market get a little bit wobbly as well. That's a key sign that Trump and some of his top allies, Scott Bessent and others, are closely watching. We've seen the Treasury market be a sign that Trump will back off of tariffs. We're also seeing that now with Iran.
Laura, what are we seeing when it comes to domestic pressures? Because clearly part of this was a response to try and calm markets down. There's also clearly pressures when it comes to cost of living and oil prices domestically. And I do wonder how much is this kind of playing into the political and strategic thinking as we head towards midterms?
This is weighing heavily. Senators are in the Capitol right now hashing out a funding bill that's unrelated to this war entirely. But this is one of the key things that's on the top of everyone's mind, if they're having to run for re-election in an environment where gas is up over $4 a gallon, hitting highs that haven't been seen for years. There's a lot of consternation about this war, particularly as there's more talk about ground troops being sent in. Those are people's husbands, sons, brothers, and they're concerned that this could really be a blooming war that lasts for months, if not years, versus the small targeted strategic strike that Pete Hegseth, the defense secretary, and Trump foreshadowed in the beginning. Now, as we reach almost this 1 month mark, there's lots of concern, both economically as well as geopolitically, that this is just a complete, total political loser for Republicans.
Laura Davison there, Bloomberg Washington Deputy Bureau Chief, with the latest on the ongoing war in Iran. The former U.S. ambassador to China, Nick Burns, says Beijing may have taken a hit on its political credibility with its allies by not intervening diplomatically to support Iran. Burns also told us he thinks Washington is hoping Beijing might push Tehran to resolve the war through diplomacy.
China is very much attached to Iran as a political ally. But I think we've seen in the Chinese reaction over the last 3 or 4 weeks of this war that the Chinese care a lot more about the predictable supply of oil and gas coming out of the Strait of Hormuz, because they're dependent to a very large extent on that flow of energy. And their investments in the United Arab Emirates, in Saudi Arabia, in Qatar, in Bahrain, in Kuwait are far more substantial than what they had coming from Iran. So I think they're of two minds about this. They didn't want to see their political ally bludgeoned the way it has. But it's interesting, David, they haven't really lifted a finger to help politically and diplomatically Iran. They're much more focused on ending the Iranian missile attacks at the Gulf Arab oil and gas refineries. I think they want a quick end to the war itself. And one of the intriguing questions here is there's going to be an end game. There's going to be an attempt to resolve this by diplomacy. Can China play a role in that? And I would say behind the scenes pushing the Iranians to an agreement. That would be, I think, the American hope that they might do that.
Former US-China Ambassador Nick Burns there speaking to Wall Street Week's David Weston. The top global headlines that we're following this hour, and President Trump's energy chief has downplayed the impact the war with Iran is having on oil prices. Energy Secretary Chris Wright was speaking at the CERAWeek event in Houston about the impact of the effective closure of the Strait of Hormuz.
Markets do what markets do. Prices went up to send signals to everyone that can produce more, please produce more. The prices have not risen high enough yet to drive meaningful demand destruction.
Indian Prime Minister Narendra Modi says the country has sufficient energy supplies to meet domestic demand. He spoke as a gas shortage hits industries from restaurants to fertilizer makers and oil refiners. Modi says India holds over 5 million metric tons of strategic oil reserves and is helping ensure safe transit for Indian vessels stranded in the Middle East. New York's LaGuardia Airport has reopened with reduced capacity after an Air Canada Express plane collided with a fire truck on a runway late Sunday night, killing both pilots. Recordings reveal an air traffic controller ordering the truck to stop just before impact with the plane, which was travelling at more than 200 kilometres an hour. 76 people were aboard the aircraft, with more than 40 needing hospital treatment.
As our airports go, LaGuardia is a very well-staffed airport. We're a couple controllers short in total, but it is a well-staffed airport. Again, 33 certified controllers that operate out of the tower here at LaGuardia.
We are taking a look at hearing from the Australian Prime Minister Anthony Albanese talking about the conclusion of the EU trade talks. A deal has been secured. We have had Ursula von der Leyen in Sydney and Canberra this week to have those discussions. The agreement to that free trade deal has been secured according to a joint statement. A new security defence partnership has been secured as part of these talks as well. Australia and the EU welcoming the conclusion of these free trade talks. And it has been a long time coming in terms of these talks, 8 years in fact to get to this point. A lot of the concerns and the disagreements arising over Australian red meat exports, they are set to rise tenfold under this historic FTA that we now have confirmation of. Meanwhile, producers will be able to use names like feta, halloumi and prosecco. There has been long-standing disagreements with Europe to restrict the use of these so-called geographic indicators in free trade. More ahead on the Asia trade. This is Bloomberg. The Eurasia Group says the planned summit between President Trump and China's Xi Jinping will further enhance stabilization of the relationship. The summit is yet to be rescheduled after Trump postponed it as he deals with the war in Iran. Eurasia's China practice head, David Meale, spoke to us in Beijing about the possible outcomes.
The world needs the commitment to the summit, and that commitment remains. What everybody is looking for, what President Trump and President Xi have made a political commitment to with each other, is to stabilize this relationship over a period of time. I think the Korea deal was a very positive deal. I think the fact that the U.S. is hosting G20 and China is hosting APEC, which means their ministers are running around in each other's big cities all year long, and the two leaders will meet in these multilateral environments, is also very positive. So sooner or later, I believe Trump will come here. I believe Xi will reciprocate and go to the U.S. And all of this sends signals throughout the bureaucracies on each side that will lead them to work together better than they would have otherwise.
You've heard all the speculation that the PLA is watching this very closely, a decapitation strike in Venezuela, a decapitation strike in Tehran. Do you buy into that kind of speculation that they're looking at avenues to employ China, that is, towards Taiwan?
I'm sure that there's a lot of watching going on. I'm a former diplomat, and this is, governments do this, and they are probably learning their lessons, assessing capabilities, and of course, China is very focused on Taiwan. It is obviously preparing for any kinds of contingencies it might face. Whether this really changes their approach, I would say very unlikely.
Does a diversion of resources, military hardware, and attention by Washington to the Middle East, does that open the door for something to happen here with China and Taiwan?
I would say absolutely not. I believe that China has a policy towards Taiwan that is very deliberate. They will do things on their terms, when and how they want to. They're not going to be opportunistic about it. It is too risky. The other thing is, I don't believe China is looking for an opportunity to intervene militarily to deal with the Taiwan crisis. I think for now, they are still trying to work with non-military means, and for some years to come, it will probably look that way.
Eurasia Group's David Meale speaking to Bloomberg's Stephen Engel in Beijing. We do have breaking news at the moment. Now, Republican Senator Mark Wayne Mullin has been confirmed by the U.S. Senate as Secretary of Homeland Security. The 48-year-old first-term Oklahoma senator will have to deal with many of the issues around DHS right now. The department has been stuck in a funding shutdown for more than a month because of an ongoing clash over aggressive immigration enforcement tactics. And he will have to deal with this funding lapse that has left most employees being forced to work without pay. And of course, that has affected U.S. airports, security screeners. We know that President Trump has ordered ICE agents to airport duty in order to help ease some of the strain there. But again, Republican Senator Mark Wayne Mullin now confirmed by the U.S. Senate as Secretary of Homeland Security. Haidi.
Shery, we're also watching as we get into the session for futures trading, at least for Europe, to see whether this sort of relief rally that we've seen from the delay or the extension of that deadline for negotiations from President Trump's side with Iran of 5 days, whether that continues to have legs or whether we'll continue to see that optimism fade. Looking pretty flat at the moment, if I'm honest. Euro Stoxx 50 futures not doing very much. A bit of positivity for German DAX futures there, though. We did see really swings in the session for Europe, previously trading higher on the news, but then a little bit more muted. We're also watching the trade front. As we mentioned earlier, Europe and Australia have finally, after almost a decade of negotiations, agreed to a free trade deal to boost that relationship. They've also signed a security and defence partnership on crisis management and security challenges. This was a deal that was almost done back in 2023, but Australia walked away over concerns over insufficient access to agricultural products. But the two sides have now come together. Clearly, there was also that sense of urgency with the Trump tariffs threatening to upend global trade. More ahead on the Asia trade. This is Bloomberg.
We're seeing a risk rally across Asia and markets in Japan pointing to upside as we're getting the PMI manufacturing numbers coming in at 51.4. This is a preliminary figure for March. The composite 52.5, services 52.8. So we're firmly in expansion territory. But of course, keep an eye on some of the big movers across Japan. More weakness on the Japanese yen as we're seeing Prime Minister Takaichi speaking at the moment, saying that they will take necessary diplomatic steps, that the stability at the Strait of Hormuz is very important for the world. This coming at a time when we're watching, of course, oil prices and its impact on the Japanese economy. We have seen yields at multi-decade highs, while the Japanese yen also continuing to weaken. Turning over to Hong Kong, the wealth sector there experiencing a resurgence as the city positions itself as a financial safe haven amid all of this geopolitical upheaval. Let's cross to Hong Kong and the China Show co-anchor, David Ingles. David.
Yeah, absolutely. In fact, Shery, thank you for that. One could argue that it is an opportune time, as obviously unfortunate events in the Middle East are, to look for, I guess, an anchor and stability amidst the geopolitical complexity, right? So I think Hong Kong this week, just to put everything into context, left side of your screen is Greater China. A series of forums, BOAO, you had the Bloomberg Family Office Summit, you have the Wealth for Good in Hong Kong, of course, that's today. Towards the end of this week, it's Art Basel. We have a curtain raiser right side for our Bloomberg clients and on the website that talks about Hong Kong as a financial haven and this war for talent that's showing up in the industry. Joining us now to talk us through the opportunities here that Hong Kong presents amidst this geopolitical storm. Joining us now here on set, Christopher Hui, Hong Kong Secretary for Financial Services and the Treasury. Good morning, and very nice to see you.
Morning.
Complex external situation, as we know. Before we get into the implications of that, I just want to get a sense of, we were here 12 months back. Give us an update. What's been the last 12 months like for you guys, specifically as it pertains to the Wealth Initiative?
I would say Hong Kong as a financial center, we've been going all out in terms of reforming our capital market, at the same time try to draw international capital here. As you can see, like for example, last year we have 119 listings in Hong Kong, and also the proceeds that we get at IPO is a record number. And at the same time, what you see is, apart from capital formation on the wealth management side, we are also seeing that increasingly more people are interested in family offices in Hong Kong. And that's why this week we have the Wealth for Good Summit here.
And what's the message this year?
As you said, I think we are in a very complex world, but that said, Hong Kong as a safe, stable, and also sophisticated financial center is always ready to serve the world. Like, for example, apart from having the conference here today, we also have a series of reforms and measures to draw global capital. In fact, we are going to put together a bill for legislative approval to extend the tax concessions that we give to family offices and funds to include more asset classes like digital asset, precious metal, and also private credit. And at the same time, we are also trying to enhance our role as a wealth management center by leveraging the overall need of corporates for internal cash management. So that's why we are going to revamp our law and also our regime to enhance our tax concession to given for these treasury centers in Hong Kong in such a way that for corporates, if they want to manage their cash internally through Hong Kong, we have a more favorable regime for them.
That's interesting. So you have structural reforms that you're looking to put in place. So you mentioned you're introducing this bill. Do you have a timetable for when investors can expect this? Just give us a rough estimation.
In terms of the extension of the tax concession for family offices and funds, hopefully we are going to put to legislative approval in the early part of this year. And for the reform they're going to give to the Treasury Center reform,
the cash
management reforms, is something that we are now putting into a legislative proposal, and we'll also put it to approval very soon.
I need to ask the connection and what we're seeing in as far as the risks and opportunities because of what's happening in the Middle East. And we know, of course, we've talked about this a lot, that Hong Kong has built this Middle East corridor. In what ways do you think Hong Kong is prepared to receive some of the flows that could be getting out that part of the world?
Hong Kong is always ready, despite what's happening around us. If you look at the reforms that I said into wealth management, at the same time reforms that we have to our capital market by lowering the threshold for weighted voting right, and also at the same time to expand the definition of technology companies to be listed here. We are always on the drive in terms of making our market more competitive. That's number one. And number two, if you look at the recent number, right now, for example, through our Invest Hong Kong, we have around 156 family offices who have already indicated their plan to set up or expand in Hong Kong. And also this time, when we have the Wealth for Good Summit for the fourth time, we are also welcoming more guests from the Middle East. Actually, there's one from the Morocco family offices that already indicated and also confirmed their interest to expand here. So I think all these are actually showcasing our role as a financial center and also being a safe, stable, and also sophisticated one in this complex world.
I see. And this group from the Middle East, they're still scheduled to come?
Yes. Yeah.
Okay, I understand. Have we seen any early signs that a transfer of some wealth because of what's happening there to Hong Kong? What conversations early conversations are you having?
If you recall, the chief executive led a delegation to the Middle East some time ago. And at the same time, as a follow-up, my bureau and also Invest Hong Kong has been closely monitoring the developments throughout with a view to identifying needs of these companies, corporates, and also individuals to see how Hong Kong can serve them better. And again, that's context. That's why we have increasing interest from the Eastern family offices to come, and it's also being seen from the turnout from this year's World Focus Summit.
Right. You mentioned one of the attractions is, this massive listing market. Very good year, of course, for ECM last year. 117, I think, 119 is what you mentioned. Recently, there's been some, I wouldn't say confusion, but there's been some conversations around the tightening of regulation around the types of IPOs, the quality of deal work that's happening. What's the government's message to investors who might not be getting the complete picture on what's taking place?
Fundamentally, we are a quality market. That's what we try to do in terms of maintaining that. Because fundamentally, for a market to thrive, it has to be underpinned by quality regulation and also quality in terms of liquidity. So we will still continue our efforts to make sure that our market is a quality one for global, regional, and also local investors.
Did it get too hot in a sense that did we reach some capacity issues last year that we needed to sort of take a bit of a chill pill and just understand and just ensure the quality of the deals?
I must say our regulators has always been on the forefront in ensuring the quality of our market. At the same time, if you look at the liquidity and also the turnover of our market, it has been very positive in terms of being a very sound platform to serve corporates when they have their financing needs. So we'll continue to do that to make sure that we are open to business.
You mentioned private credit and gold. Both have somewhat wobbled recently. Gold prices, as you've probably seen, have come down a little bit. Private credit, some worries around withdrawals in other parts of the world. It's worth noting as well. Does that concern you at all, given the longer-term initiatives you want for both those asset classes?
I would say what we are trying to do here is to provide a platform in such a way investors who have the risk appetite, they'll be able to leverage our platform to do their wealth management needs and also at the same time to pursue their own interests. And that's against the backdrop, apart from having this new regime to extend the tax concession for these new asset classes, we're also making Hong Kong an international gold trading center. And against that backdrop, we are going to expand our gold storage capacity to beyond 2,000 tons in 3 years' time, and also building a centralized clearing system for OTC gold contracts.
And I guess you still can't tell us where the gold vault is going to be located, right? I'm kidding. I know you're the chair of that. Final question. Is it too early to figure out what the impact on growth for GDP growth will be for Hong Kong, and also inflation because of what's going on?
I think Hong Kong has been very resilient throughout, despite the different economic cycle and also different changes. And of course, we've been, like other economies, closely monitoring what's happening around us in terms of its impact on us. But so far, in terms of our achieved economic growth last year, I think it's very promising, 3.5% real growth. And we'll continue to pursue reforms on all fronts to make sure that we continue to be competitive.
Christopher, thank you so much for taking the time. Have a good conference today. I think I'll see you tomorrow as well, tomorrow afternoon. Thank you so much. Christopher Hui there, guys. Hong Kong Secretary for Financial Services and the Treasury. Haidi.
David Inglis there in Hong Kong. Well, coming up, we'll be talking about what would happen if Australia's 36-day petrol supply runs out. An expert from Macquarie University joins us. This as we hear from an Iranian lawmaker ruling out negotiations with Trump. We'll have more on this next. This is Bloomberg. All right, well, let's get the latest when it comes to this Australia-EU trade deal. Australia and the European Union have struck a new agreement, this after almost a decade of negotiations. European Commission Chief Ursula von der Leyen and Prime Minister Anthony Albanese signing that agreement in a ceremony in Canberra. We're still hearing from them now, but let's get over to our Asia agriculture reporter, Ben Westcott. And we came close in 2023, but this has been a long time in the making and significant given the current trade and global environment.
Yeah, they said it couldn't be done. They said those two crazy kids couldn't work it out, and yet they have today. Australia and the EU have announced that they have signed a free trade agreement. It was very, very tense for a long time, and in fact, basically the two sides have been haggling over about the same 2 or 3 issues for about 3 years, and those big issues are beef. The EU didn't want as big exports in as Australia wanted. sheep meat, sugar, agricultural produce, and then of course the geographical indicators. And if you don't know what that means things like feta, prosecco, those classic European names that are attached to a lot of things that Australia grows and makes, and that the Europeans didn't want us to make anymore. So essentially, those were the big haggling points, and now we get to see in the amid all the trumpeting of billions of dollars of new revenue between the two countries, how that actually plays out on the ground for producers.
Ben, how much is this deal about Australia and the European Union, but also about what's happening with the United States, what's happening with China as well?
Yeah, China and the US are playing a big role in this agreement signed here today. Essentially after that 2023 breakdown in talks when both sides were blaming the other one for blowing up the FTA, there was a general feeling that there wasn't really going to be an FTA potentially for, who knows how long. But once Trump came back to the White House and once China started putting restrictions on EU across a range of fronts, suddenly you started to hear from both sides, oh, the other side really wants a deal. Now, who wanted it more? That's a question for the ages, but there was no doubt that both sides saw signing a free trade deal as a major goal amid the global trade disruptions. They basically wanted to say, we both stand for a certain thing, we both stand for free trade, we stand for a world without tariffs, and this is how we're showing it.
So Asia agriculture reporter Ben Westcott with the latest on this hard-fought deal. This is we continue to hear in that press conference with Prime Minister Albanese and Ursula von der Leyen. Ursula von der Leyen saying that the deal is an example of what she calls collective resilience in an uncertain world where great powers are using tariffs as leverage and supply chains as vulnerabilities to be exploited. Speaking of vulnerabilities, of course, both Europe and Australia dealing with their own energy crises at the moment. Australia, in its part, facing a potential energy crunch as higher oil prices bite. The nation imports more than 80% of its fuel from Asia, produces little crude. When it comes to refined crude of its own, petrol prices are surging at the pump and rural regions are vital to mining and farming, and they're fearing shortages. The government has eased reserve rules and appointed former regulator Anthea Harris as the fuel czar to steer the response to these Iran war disruptions. Let's bring in now Lurion de Mello, who's a senior lecturer in applied finance at Macquarie University. Lurion, great to have you with us. And I wanted to take a step back because you make the very interesting point that the way that perhaps the government and states are calculating fuel buffers may not be quite as straightforward as we might think.
Yeah, look, that's a minimum stock obligation which the government's referring to. We do not have a strategic reserve in Australia, unlike the US strategic reserve and the reserve held in Japan, for example. So it's pretty much fuel that's been, it's a refined fuel. We don't have any storage of oil. So it's just refined fuel that's been kind of distributed out of the minimum stock holding, to make all the shortfall from the imports.
And that is simply the reality, right, when it comes to the lack of refining capacity and how that's been wound down over the past decades. What are the options here for the government? Because, I think proponents of green energy would say, well, this would have been a great time at all of the previous points of this crisis and previous crises to have talked about that energy transition.
Yeah, I think the energy transition is happening, but what Australia relies is on diesel, and this is a crucial fuel that's supporting so many different sectors of the economy, not just the trucking, but farming. It provides fuel as backup energy for wind farms, for hospitals, for ambulances. It's an industrial fuel. And when you try to, replace an industrial fuel, that is very challenging. I know there's a lot of discussion around, moving to, electric vehicles and, electric trucks. And I think Australia is not the geography in Australia is not really suited for, for having these electric trucks. So while the transition's happening on the passenger vehicles but in terms of the bigger economy, in terms of diesel's, utilization in industry and in transport, I think the discussion about renewables and bringing in more sort of alternative is not really suitable at the moment.
So, Lurion, where's the key structural weakness when it comes to Australia's energy system? Is it all to do with shipping and the Strait of Hormuz? And To that point, how does it compare to, say, international energy security standards?
Yeah, look, Australia gets most of its fuel, from South Korea, Singapore, Japan. China is a key player when it comes to jet fuel. So most of the oil that gets, sent to these refineries in Asia, comes from the Middle East. We do not really import a lot of oil from the Middle East. Most of our oil that is, refined with the two remaining refineries comes from, sort of Southeast Asia, from Malaysia, from Brunei. So it is, I guess, a two-way process, because the oil has to get to the refineries in Asia and then in turn bring it over here. It hasn't been really profitable for the Australian refineries, because when the refineries were, going, in those days where we had 7 to 8 refineries, most of the oil kind of was sourced from the Bass Strait. But the oil resources have kind of dwindled a little bit in Australia. So we don't really produce a lot of oil. Anything that we produce is like a mild condensate, and that gets exported to Asia, to some of the refineries there. So we don't really have oil over here. So the only option for the government, is to import more fuel. But then there's other issues that you cannot have, massive storage of fuel depots of refined fuel, and you cannot hold that fuel for a very long time.
We heard from Fatabiro just yesterday, actually, speaking about Australia's potential to be a leader when it comes to energy security globally. Take a listen.
I really hope that Australia make a big move based on this, a lot of resources, huge opportunity, geopolitical opportunity, being a trustworthy trade partner, and the predictable investment environment for the businesses. Bring this all together, Australia can well be a rising star of the global energy economy.
What opportunities are policymakers missing here?
Yeah, look, Dr. Fatabiro is, I think, talking about Australia's gas resources. I mean, we have, one of the world's biggest gas exporters, and yet we don't have, downstream facilities where we utilize gas. If you look at China, look at India, a lot of the trucking industry, is running on LNG trucks, on utilizing gas. I think this has been a missed opportunity. The government does not allow any new, oil drilling licenses, or even gas is very challenging, particularly on the east coast of Australia. So I think in terms of our energy contribution, and in terms of possibility for Australia to contribute, not just domestically but also to contribute to the globe, is gas. Unless we start looking for oil in the Australian Bight, or allow companies to frack for resources onshore, I think gas is something that the government has kind of missed. So we really need to kind of transition to a gas type economy and reduce our dependency on diesel.
Lurion, Mello, really great to have you with us, Senior Lecturer at Applied Finance, at Macquarie University. We will have more on Australia Ahead. That's every Tuesday at 11:40 a.m. if you're watching here in Sydney. Plus, tune into our Bloomberg Australia podcast, delving into the biggest stories shaping the country's role in global business. This is Bloomberg.
Duke Kunshan University Executive Vice Chancellor John Welch believes that China is playing its cards right by repeating its message of stability and non-interference amid the Iran war. He spoke to us on the sidelines of the China Development Forum in Beijing.
At the moment, I think it serves China very well and is consistent with past practice not to become overtly involved, though behind the scenes, of course, like any other major economy integrated into the global economy, China has to be concerned about the impacts that the war in the Middle East is potentially going to have.
What would you say that impact is going to be? Because we don't know how long this will last, but obviously they do have a lot of interest in the Middle East. They've have invested billions and billions into the Middle East. The choke point affects China in the Straits of Hormuz. So the oil shock, on the one hand, could help them kickstart their battle against deflation, but at the same time, there's good inflation and there's bad inflation. This would be bad inflation because it trickles down to the industrial base.
You're absolutely right that it's bad inflation in that it's price rise driven inflation from the costs of the inputs increasing, and that's not good inflation.
Rather than demand-driven.
That's not based on consumer demand-driven inflation. But at the same time, I think it's important to note that for the next few weeks, maybe 2 or 3 months, China did invest heavily in building up its oil reserves to 1/3 of global reserves, and that probably is going to insulate China longer than other Asian economies from the effect of the oil shock. Perhaps on the liquefied natural gas front, China a little bit more vulnerable, less weeks of supply on hand in that regard. Everything depends, of course, on how long before the straits can reopen. And if the straits do not reopen within 2 to 3 months, the global economy is going to be in for a very bad period. It's going to be similar, Steve, to COVID. At the moment, COVID started, it was confined to one country and then Asia, but the contagion spread over the course of 2 or 3 months. And we're going to see the contagion of this oil crisis spread around the world over the course of the next 8 weeks in a very severe way.
To Kunshan University Executive Vice Chancellor John Welch there speaking to our Chief North Asia correspondent Stephen Engel. This is Bloomberg.